Welcome to your deep dive. Today we're taking a close look at the second quarter 2025 results from Mr. Cooper Group, and we're asking, how has this mortgage giant managed to, well, not just survive, but actually thrive and innovate in what's arguably one of the toughest housing markets we've seen in a while? Their earnings call gives us some pretty compelling answers, although it's worth noting up front, they didn't take questions this time around because of the pending combination with Rocket, which, for an earnings call, that's definitely a shift from the usual practice.
Yeah.
Makes their prepared remarks even more important, I think.
Absolutely. You really have to read between the lines, or rather, listen closely to what they did say.
Okay, so let's kick things off with the headline figures. Mr. Cooper Group called it a very solid quarter. They emphasized, consistent, recurring, predictable performance. Their operating return on common equity, ROCE, that came in at 17.2%, which is up slightly from last quarter's 16.8%, and yet comfortably within their guidance range of 16 to 20%.
And they even pointed out, didn't they, that if they normalized capital back to year-end levels, because they paused buybacks for the Rocket deal, that ROCE would have been closer to the upper end of the range.
Right, exactly. So potentially even stronger underlying performance there.
Yeah.
And the balance sheet looks very solid.
Yeah.
Capital ratio at 26.6%. That's quite robust.
Super strong, yeah. And liquidity at $3.8 billion. Plenty of cushion.
And crucially, asset quality remains, well, pristine seems the right word. Delinquencies actually declined in the quarter to just 1%.
Just 1%. That's impressive.
Looking at the segments, servicing brought in $332 million pre-tax income. That's up a healthy 15% year over year. And originations added $64 million pre-tax, which, given the high rates, is pretty notable.
What immediately jumps out at me from all that is the consistency, that 17.2% ROCE. When you think about the broader market, the MBA says originators have lost money in 10 of the last 12 quarters.
10 out of 12.
Wow. Yeah. So for Mr. Cooper to be posting solid double-digit returns for, nearly 2.5 years straight, it's not just good. It really demonstrates the power of their scale, their platform, that balanced business model they talk about.
It really does feel like they're defying gravity sometimes.
Yeah.
So let's pull back the curtain a bit. How are they actually achieving this resilience? What are the operational levers?
Well, management kept hitting on a few themes: operating leverage, fee income, and nimble execution, especially in originations.
Okay.
So on the servicing side, that portfolio is holding pretty steady around $1.5 trillion. That's post-Flagstar acquisition, of course.
Right. The Flagstar deal was huge for them.
Absolutely. A real game changer for their scale. Now, there was some client movement dynamic stuff. One client deboarded $12 billion this quarter, another $50 billion earlier this month.
Okay, that sounds significant.
It is, but it was largely offset. They won a new client bringing in about $40 billion in loans expected by year end. Plus, they expect to board around $20 billion in MSR acquisitions in Q3.
MSR's mortgage servicing rights.
Exactly. So net, the portfolio size looks pretty stable, maybe growing slightly. But here's the fascinating part, I think. The operating leverage in servicing income. Revenue's up 13% year over year, which kind of tracks the portfolio growth, but operating expenses only up 6%.
Only 6%.
That's real efficiency.
It really is. And they say it's down to just relentless focus on process improvement by the team. The latest MBA benchmark survey from 2024 apparently shows their cost to serve is now almost 50% below the industry average.
50%.
Yeah, and that gap has actually widened quite a bit from the year before, so they're pulling further ahead.
So it's not just scale then. They're really leaning into innovation technology. You mentioned AI.
That's right. And this tackles that key question.
Yeah.
How do you keep that cost advantage and maintain or even improve customer experience? They're investing heavily, implementing new AI solutions. They specifically called out how well-suited AI is for large call centers.
They've fully rolled out this proprietary app called Agent IQ. It helps the agents on calls, interprets questions, tracks customer sentiment in real time, pulls up info instantly, generates summaries.
So it makes the human agents more effective.
Exactly. It empowers them. But now they're even beta testing agentic features where the system itself handles simple tasks, answering basic questions, fetching data in chat, all under human supervision and quality control, of course. But it's a glimpse of the future for optimizing these ops.
Very interesting. Okay, that's a strong story on the servicing side, leveraging tech. Shifting gears then, what about originations? You said $64 million pre-tax, $9.4 billion in fundings. How are they managing that with rates so high?
Well, the direct-to-consumer channel, DTC, that's got really strong momentum. Volumes were up about 40% just from the previous quarter.
40% sequential. Okay, what's driving that? Not rate and term refis, surely.
No, you're right. It's home equity and cash-out refinances. Together, they made up nearly 60% of the mix this quarter.
Ah, tapping into that home equity.
Precisely. And they're good at it. They did 2 home equity securitizations in the quarter, got great feedback from investors. Investors seem to appreciate their loss mitigation skills, their track record. And Mr. Cooper sees a huge runway here. They estimate their customers have over $900 billion in available equity.
$900 billion. That's a lot.
It's massive. They see it as a multi-year opportunity for their DTC team. They called home equity a mainstream consumer product now.
So less focus on the traditional refi market for now.
Well, the rate and term opportunity is limited, obviously, but they did note 22% of their customers have note rates above 6%.
Right.
So if rates do rally, even briefly, they're positioned to capture some volume there.
Always keeping options open.
And they haven't taken their eye off the ball operationally either. Turn times locked to funding were 6 days faster than a year ago.
Even with higher volumes.
Yeah, despite 68% higher volumes, that's impressive execution.
Okay, and the correspondent channel, how does that piece fit in?
Still performing well. They're consistently a top 5 player there. And they expect to keep gaining share, but importantly, while maintaining margin discipline, not just chasing volume.
Right, smart. Okay, let's turn to the financials in a bit more detail. Financial health, risk management. They flagged that as a strategic focus.
Yes, they did. So reported net income was $198 million. That included $269 million in pre-tax operating income, plus a $30 million positive mark-to-market net of hedges.
Okay, let's unpack that mark-to-market a bit. MSRs were marked up.
Right. They marked up the value of their mortgage servicing rights by $59 million. That reflects higher interest rates, makes servicing existing loans more valuable, lower CPRs.
Constant prepayment rates.
Yeah.
Fewer people prepaying.
Exactly, and some other non-rate factors. But that was partly offset by $29 million in hedge losses. They aim for a 75% hedge ratio, so that's kind of expected when MSRs get marked up significantly. It smooths things out.
Got it. And there were some other adjustments in that net income figure.
Yeah, about $15 million in adjustments, plus $7 million in intangible amortization. The adjustments included roughly $9 million for Rocket merger costs and $4 million related to Flagstar integration. Still some tail there.
Okay. And corporate expenses.
$48 million for the quarter. They expect that level to continue in Q3, mainly due to ongoing IT investments in servicing and correspondent platforms.
Investing for that future efficiency. Makes sense. Let's circle back to asset quality. That 1% delinquency rate is really striking. How are they maintaining that? What's the secret sauce?
Well, part of it is portfolio construction. They emphasize high FICO scores, low loan-to-value ratios for customers, just good quality loans to begin with.
Starting with a good base.
Exactly. And then layered on top is what they call their best-in-class loss mitigation. They work hard to keep people in their homes. They are keeping a close eye on the Ginnie Mae sector, specifically FHA loans.
Right. Ginnie Mae deals with government-backed loans, FHA, VA, different risk profile sometimes.
Correct. And while their FHA delinquencies have ticked up, like others have seen, they're still well below their peers. And strategically, they've kept FHA loans capped at 15% of their MSR portfolio. They see it as higher risk, apparently. And they've largely avoided loans originated in 2023 and 2024, which they view as particularly risky vintages.
Interesting avoidance strategy there.
Yeah. And on FHA, they also noted that FHA itself recently tightened standards for loan modifications, limiting them to once every 24 months. Mr. Cooper actually views that as a prudent move by FHA, supporting risk management, even though it means fewer delinquent borrowers will qualify.
Okay. What about the student loan issue? The end of the moratorium, we heard concerns about that impacting mortgage payments.
They did see a bump in delinquencies among borrowers with student loans, peaked at 8.7% in April, settled back to 7.9% in June.
So noticeable.
Noticeable, yes. But here's the context. Only about 16% of their total customers have student loans. And the overlap FHA customers who also have student loans, that's just 3.5% of their total portfolio. And importantly, that small group tends to have significant home equity.
Ah, so a cushion there.
Right. So bottom line, they don't see it as a material risk to their overall performance. They seem to have it well contained.
Okay, good context. So pulling it all together, what does this mean for investors? What's the strategic picture looking forward?
Strategically, they sound really positive about the Rocket combination. They mention being thrilled that Rocket closed the Redfin acquisition. They see that as a key piece of the integrated home ownership platform they're building together.
Right, that whole end-to-end ecosystem idea, browse, finance, manage.
Exactly, capturing more of that customer journey. They said they're working closely with Rocket on integration planning, want to hit the ground running post-close. Another big strategic development is the launch of their first MSR fund.
The asset-light strategy you mentioned.
That's the one. $200 million in initial commitments, planning to scale it quickly. They're partnering with, quote, blue-chip fixed-income investors who see Mr. Cooper's platform as key to maximizing MSR value. So it lets them grow their servicing platform, leverage their expertise, without putting all their own capital on the line for MSR purchases.
Smart way to scale.
Mm-hmm.
And the outlook for Q3? More of the same.
That's the guidance. Continued consistent performance. They point to that strong capital ratio up from year-end, which is quite something for a mortgage company right now, combined with the operational excellence. It all supports that outlook. They really do seem positioned not just to weather the storm, but to keep executing.
Okay. Now, before we wrap up, time for our This Is Not Financial Advices segment. Just a reminder, what follows is purely a speculative thought experiment based on today's discussion. Absolutely not financial advice.
All right, investment committee hat on. Given everything we've heard, especially Mr. Cooper's strong execution in home equity, here's a potentially, let's call it, outrageous but plausible trade idea, a long-short pair trade within the mortgage origination space.
Ooh, okay. Long, short. Yeah. You go long on companies like Mr. Cooper, companies strategically pivoting, showing real growth in home equity and maybe other non-rate sensitive channels. That $900 billion in customer equity Mr. Cooper identified, that signals a huge, potentially durable opportunity. They seem very well placed to tap. Their ability to securitize these loans, maintain that asset quality, it all backs up the long case for a resilient model. Okay, so long the diversified equity-focused players. What's the short side?
Simultaneously, you go short on originators who are still heavily reliant on the traditional rate and term refinance game. As the call highlighted, and as we know from industry data, that segment is just facing massive headwinds. High rates, affordability issues, leading to losses across the board for many.
So betting on the divergence.
Exactly. The trade exploits that clear difference in business model resilience and where the market opportunity seems to be shifting. Mr. Cooper's consistent returns versus the industry struggles. It suggests a potential fundamental shift underway.
Interesting idea. Definitely food for thought. Yeah. So let's quickly recap then. Mr. Cooper Group put up a strong Q2, driven by, well, that balanced model, real operational efficiency gains, smart tech investments like AI. They've kept asset quality incredibly clean, and they seem well-positioned for future growth with the Rocket deal integration and this new MSR fund strategy.
Yeah, it really makes you think about the broader mortgage industry, doesn't it? Mr. Cooper's track record, their agility, what does it suggest about the future? Especially for companies that really embrace technology and diversify their services in these very dynamic rate environments. Is that the winning formula going forward?
A very pertinent question. And as always, remember, nothing we discuss here constitutes financial advice. We're just aiming to help you get informed quickly, help you connect the dots. We hope this deep dive has been useful. We always appreciate your insights and questions. Thanks for tuning in.